This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Back in Chapter 14, we saw the various Cgt Reliefs that were available to individuals, mostly individuals who were in business. Most of the reliefs available pertain to qualifying business assets, other that is than the principal private residence. Now, when it comes to corporation tax, the reliefs for capital gains are very much easier. For, as we'll discover, there is only one relief that is available. It's the classic rollover relief in relation to replacement of business assets. Now, to be able to understand this, you simply need to understand what we dealt with back in Chapter 14. Now, if it's been a while since you looked at Chapter 14 and specifically at rollover relief, what you now need to do before we go any further is to go back, re-look again at Chapter 14, the rollover relief section, page 91, and work through the examples and the issues that we dealt with there. If you do that, then you will find that this is now a very quick and easy section for you to deal with. Because the only thing that is new, that is different to what we did back there, is because we're dealing with corporate tax, we're dealing with indexation allowance. Indexation allowance that will reduce, of course, any chargeable gain, though would have no impact in terms of losses, as we know. For rollover, there must be a gain, so we'll clearly be talking about gains arising. So literally, all we've got to do, calculate a gain, basic calculation, company sells, usually a property, of course. We need to compute the gain to know not just the proceeds, but the cost, and based on that cost, the date when we bought it, the date when we sold, we can establish an indexation factor. We apply that indexation factor to the allowable cost figure, and we get our indexation allowance. So the gains calculation is simple. Proceeds, less cost, less the available indexation allowance. Now, if that disposal is of a qualifying business asset, 9 times out of 10, if not more, a property used within the trade of the business, now a company, if the disposal is of a qualifying business asset, then if we reinvest those proceeds, some if not all of the proceeds in another qualifying business asset within the relevant timescale, again go back to Chapter 14 and remind yourself of that, but it was within a 4-year window of opportunity that ran from 12 months before to 3 years after the disposal date. Now then, if we reinvest all of the proceeds, full rollover relief was available, i.e. all of the gain that arose on the disposal could be deferred. If we reinvested some but not all of the proceeds, then the best we could hope for was partial rollover relief. Now again, as I keep saying, you need to go back to Chapter 14 to see how we dealt with full rollover and partial rollover for individuals. And the only new thing that comes in here is that we've got to use indexation allowance in computing the original gain that is available for that deferral in the first place. All the other rules are the same. What you'll also see there was that when we disposed of a qualifying business asset, the business asset that then we replaced it with or that we acquired there might be what we called a depreciating asset. Now, a depreciating asset was one with a life of no more than 60 years. And for that, there were 2 basic examples. In terms of properties, leasehold properties, where the lease is of no more than 60 years, or automatically that we'd assume to be having a life of no more than 60 years, a depreciating asset. You may recall the other one, fixed plant and machinery. So, at this point, if we can't recall all of that, it would be very wise to make the next, literally not very many minutes on this section then so much easier for you. Go back and revise there from page 91 through your basic rollover relief. And then, of course, rejoin us, and I'll take you through an example dealing with that same area, but simply dealing with corporate tax instead of personal tax. Okay, well, hopefully refreshed now from your revision of Chapter 14 and rollover relief specifically there, we can now deal quickly and successfully with how do we deal with rollover relief in corporate tax. Right, simple little example that illustrates all of the 3 things that you will have read about in terms of that note, and I discussed again in this introduction. That is either where we replace one business asset with another, usually property for property. We will be dealing with either full rollover, partial rollover, or what we've called holdover, where the gain will still be deferred, but the manner of that deferral is somewhat different. So let's see what we've got in this example. Now again, do make a note of it. You might want to pause again while you write down this information. But let's see what we got. So again, if you're dealing with, though there is too much information here for an objective testing question, but if you're dealing with an objective testing question, always when it comes to capital gains, sort out who is the taxpayer. Are you dealing with an individual, or are you dealing with, as of course it is here, a company? So we've got a company sells a property used in its trade for £500,000. That's the first thing that we wanted to know as regards, once we've worked out its corporate tax, that is that the property here used in its trade, it would appear that my pen has stopped working at this point in time, a property used in its trade here is sold for £500,000 and moves into a rented property on a 12-month lease while reviewing 3 long-term replacement options. Now then, again, once we've discovered it's a company, so we know it's corporate tax, a property used in the trade, it's a qualifying business asset. We've sold for £500,000 and we've moved into a rented property. Sales proceeds £500,000. That's a critical figure. Moved into a rented property. So at this point, there'd be no immediate rollover relief available. But of course, the window of opportunity, as we've said, for rollover extends from 12 months before to 3 years after the disposal date. Well, this lease that we're currently in is only a 12-month lease. Therefore, we'll be well within the 3-year period following the date of disposal in which to make the reinvestment and then go on to claim our rollover relief. So what have we then got as our replacement options? Corporate tax, company sells a property, used in its trade, qualifying business asset, proceeds £500,000, though currently in a rented property, it's only on a 12-month lease, so as long as after that and within 3 years of the date of disposal, we make a suitable reinvestment in another qualifying business asset, then either rollover, as you'll have seen from 2 of these options anyway, or holdover will then be available. So what do we now look at? I'm not sure whether you can see the sort of finger pointing here, the arrow on your screen, but I'm pointing now at the £500,000 proceeds. Right, then look at option 1, a freehold property. Freehold property is a non-depreciating asset, and one that we have bought for, or will buy for, £600,000. Significance, therefore, and what you should have interpreted immediately from the first reading of this: sold for 500, bought for 600. That means that full rollover relief is available. What does that mean? It means that all of the chargeable gain, should we now choose to make the rollover relief claim, may be deferred. How does rollover work? Again, from your study of Chapter 14, we should know well that what it means is it will reduce the base cost of the newly acquired asset, i.e. that 600,000, by making that cost lower when it eventually, ultimately, is sold. With a lower cost, it's got a bigger gain, and at that point the gain will crystallise. Or will it? Of course, at that future point in time, what might again happen? Well, of course, having sold one, we might buy another. So again, a deferral process may continue on ad infinitum, as they say there. That could continue on, and the only time that any deferred gain will crystallise is at some point we fail to reinvest all the proceeds. Now, if of course we were to go to option 2, the freehold property, again freehold, so we're talking rollover, non-depreciating asset, costing £450. That means we have failed to reinvest all those proceeds of £500,000, and therefore only partial rollover will be available. How that works we'll look at again in a moment's time. The third option, a 55-year leasehold. When we read that, we must recognise it to be a depreciating asset. A leasehold property used in the trade, is clearly a qualifying business asset, but as its life is of no more than 60 years, it is classed as a depreciating asset. And though here we have reinvested 540, so all of the proceeds of 500, all of the gain that arose will be capable of deferral if we make this claim. The manner of that deferral is what is different, which again, hopefully you've just refreshed your knowledge of based on what you've read back in chapter 14. Right. To be able to deal with that, we need to know, of course, what is the capital gain. Now, we know what the property is sold for. It's $500,000. The property, we're told, had been purchased back in 2012 when the trader started that should say its business there, it's a company, at a cost of £300,000. And at the date of disposal, an indexation factor of 0.2 was available. Now, clearly in a question, and with the practice examples you'll have in this chapter to do for yourself, what you may not be given is the indexation factor. You may have to work that out for yourself. So you would be given, of course, an RPI for the month in 2012 when sold, and now for the month of disposal, and you'd work out that indexation factor, of course, to some 3 decimal places. Right. Let's therefore have a little go at this and move on to a page where I can actually write. And let's change this over and let's get going. Right, first of all, we compute the chargeable gain. So what were our sales proceeds? So we'll record all of this in thousands of pounds. We've sold for 500,000. What was our original cost? That was 300,000. Take it away, and we have an unindexed gain of £200,000. Indexation allowance. What is our indexation factor? Again, remember, you may have had to have worked that out for yourself. 0.2 as given here, times your allowable cost. That was £300,000. 0.2 times 300 is, I think, some £60,000, bringing us down, therefore, to a chargeable gain of, well, that'll be 140. So a gain has arisen on this disposal in this chargeable accounting period for the company of £140,000. Unless we make a rollover relief claim, that gain will feature on the company's corporate tax computation, £140,000 to be added in deriving the company's TTP, its taxable total profit, which now, at the current tax rate, would be charged to corporate tax at 19%. But given the plan here for the company, it will be possible for a rollover relief claim to be made, depending on which particular acquisition we follow through once this current 12-month rental agreement is out of the way and we purchased our longer-term replacement property. Now, there were 3 options, of course, that we saw. Our first option was a freehold property, and that was some £600,000. What does that mean? It equals full rollover relief. Full rollover relief means that all of that chargeable gain of £140,000 will be deferred. The corporate tax computation will show chargeable gain nil. See Note 1, Note 47, whatever it might be now, that would explain that the chargeable gain of 140 would then be eligible for full relief. Now again, as you might have seen, this particular rental agreement was for 12 months, following on from whatever our disposal date was within the accounting period. You may be thinking, well, it's possible, of course, that the reinvestment will take place after the date when the corporate tax would be payable for this period. If not through quarterly instalment payments, then 9 months and 1 day after the end of the accounting period. No problem. If by the date that the rollover relief claim became available to you, you had in fact already paid your corporate tax on a TTP inclusive of the gain, not a problem. You put in your rollover relief claim and HMRC will pay back to you the corporate tax on what is now the deferred gain. So full rollover relief will be available. The entire gain of 140 will be deferred. How does that work? We roll over, we deduct from our new acquisition cost. So it will equal, therefore, a deemed cost on our new property purchased of the actual cost, 600, minus the deferred gain of 140, equals 460,000. So going forward, the property that has now actually cost us 600,000 will be deemed to have a cost of 460,000. When that property is subsequently sold against its sales proceeds, you would deduct a cost of 460. And in corporate tax, the indexation allowance would then be based on that allowable cost of 460. So there's a price that is paid by the company in relation to this claim. The allowable cost for the future being lower at 460 instead of 600 means that there will be a smaller amount of indexation allowance. But of course, that said, if you went on to sell this property costing 600, I'll make a number up, for say £800,000 in however many years' time, if you then replace that with another asset, another qualifying business asset that has cost at least £800,000, then all of that gain will continue to be deferred. Rollover may continue on and on and on. The only time where any part of any gain arising will remain chargeable following any rollover, any deferral claim, is if we fail to reinvest all of the proceeds. That doesn't happen with option 1, it's full rollover, but it does happen with option 2. So this is now partial rollover because the freehold property, again a non-depreciating asset, the freehold property is going to cost £450,000. We sold for 500, so we failed to reinvest all the proceeds. So that therefore equals partial rollover. Now, how do we show that? In terms of your calculation, it didn't change the fact that you had a gain of £140,000. And we were then going to deduct, hope you don't mind me abbreviating here, the rollover, less rollover relief. But not all of that gain may be deferred. It's only partial rollover relief because having sold for 500,000, we buy for 450. So that will mean that some part of this gain remains chargeable. And the way that we calculate this and deal with the rollover is by working out how much of the gain actually remains chargeable. And that's a very easy calculation because what we do is to compare what we sold for, £500,000, with what we bought for, 450. So we've taken out 50,000 of those proceeds on this deal. So to the extent that we fail to reinvest all of the proceeds, that amount of the gain, i.e. here, £50,000, 500 minus 450, that 50,000 will remain chargeable. So if we're going to remain chargeable on 50,000, the rollover is simply a balancing figure. 50 away from 140 would mean 90 would be the extent of our rollover. Now, if 90 is the extent of the rollover, what does that mean? It means that the deemed cost of this newly acquired asset will be the actual cost, 450,000, that's what we bought for here, less the rollover of 90, and that therefore will bring down that deemed cost to 360. Again, a figure then to be used as and when this property is subsequently disposed of. Now, if all you require to do is just do the calculation, so it's an objective testing question or part of a computation, then that's it. You don't need to do anything else. You've done the numbers. If you were asked to both calculate and explain the implications of the rollover, then always something that, remember, we add in, having dealt with partial rollover. At this point in time, still within the 3 years of the disposal date, so still within the relevant window of opportunity for rollover relief to be available as regards a purchase of a qualifying business asset, at this point, we have only reinvested £450. At this point, still £50,000 of our proceeds have not been reinvested, hence that amount of chargeable gain. But we could now identify and explain to our client that if still, as we are, this would now be 12 months, presumably following the disposal date of the original property, still within the 3-year window of opportunity, if within the next 2 years following that acquisition date, still within the 3 years of the date of disposal, if then we were to go out and reinvest a further £50,000 in any other qualifying business assets, then further claims for rollover would be available. So it is only partial rollover at this point in time. Please again remember that rollover does not necessarily mean, though dealing obviously always with one disposal, that you are necessarily dealing with just one acquisition, usually a direct replacement for the asset, which is usually a property that you have just sold. No, with rollover here, though partial at this point in time, if we were to go out and reinvest that remaining £50,000 within the 3-year deadline of the date of disposal, then further claims for rollover would be available. No doubt at that point, of course, we would already have paid the tax on this chargeable gain. No problem. Any subsequent claim, as we said but a few minutes ago, any subsequent claim that is made, that would go back to this accounting period, remove the remaining £50,000 gain, on which we had already paid 19% tax, and we would therefore get that tax back as a repayment from HMRC. So always watch out. If you ask to explain as well as calculate a partial rollover situation, make the point that if within 3 years of the disposal date, further reinvestments in other qualifying business assets should occur, then further claims for rollover would be available to you. Okay. The third option was a very different one, and that was a leasehold property, that leasehold being 55 years, and the leasehold property cost £540,000. Right, things to identify on a first read through. It's a 55-year leasehold property. That therefore equals a depreciating asset, which equals, now again, I use this term and other writers use it, they may simply refer to rollover again, but it's holdover relief that is available. Inasmuch as that we sold for 500, we bought for 540, it equals full deferral of gain. So the full gain is now able to be deferred. If again we had bought for less than 500,000, the same logic would apply as a moment ago. That to the extent that we'd failed to reinvest the proceeds, any amount of monies taken out on the deal, that part of the gain would remain chargeable. But here we've reinvested it all, so full deferral. But it's very different to how we applied rollover. With rollover, we reduced the base cost of the newly acquired asset by the amount of the deferred gain. That now does not happen. Where we're dealing with holdover, we do not reduce the base cost of the newly acquired asset. Instead, the gain is deferred until the earlier of. Now again, at this point, I hope you can remember it. If not, go back and check it out. I'll take you through it, but you're going to have to make sure walking into the exam room that you know this particular rule, that it's deferred until the earlier of. Firstly, the pen's gone again. Okay, until firstly, let me see if a new page will work. Until the earlier of. Now it works. Inanimate objects, computers, the bane of our lives. No matter. But one, an obvious one, I hope. The date of disposal of the leasehold property. Or two, the cessation of the trading use of the property. You stop using it in the trade and you decide instead, as it's surplus to requirements, to let it out. It no longer has a trading use. That would cause the deferred gain to crystallise. Or thirdly, and second to the date of disposal of the lease, the most likely one is 10 years from the acquisition date. If nothing else has happened, 10 years from the acquisition date, the deferred gain will then crystallise. But hey, if you have a choice between being taxed on a gain now or in 10 years' time, as a company, I think we'd probably take that choice there and be taxed at that later point in time. Okay, so recognise therefore when dealing with a problem such as this, first of all, as we said, who are we dealing with? Is it an individual, an unincorporated trader, or is it a company? Either way, the provisions, the principles are the same. That for rollover to occur, we must be disposing of a qualifying business asset and then reinvesting the proceeds in another qualifying business asset. The reinvestment or reinvestments must take place between 12 months before to 3 years after the disposal date of the qualifying business asset. What then will be done with the gain? Well, it now depends on what we buy. If we were to buy another non-depreciating asset, i.e. a freehold property as we've seen here, then on that basis, or indeed a lease of more than 60 years to be fair, but usually a freehold property, then either full rollover or partial rollover will apply. Full rollover if we reinvest all the proceeds. Only partial rollover at best if we reinvest some but not all of the proceeds. If, thirdly, instead of buying a non-depreciating asset, we buy a depreciating asset, in this example a lease, it could otherwise have been fixed plant and machinery. Were we to do that, again within the relevant time scale, to the extent that we have reinvested those proceeds, either full deferral or partial deferral would be possible. But the deferral is different. We do not roll over against the base cost of the newly acquired asset, whether that, as here, is the 55-year lease or was any fixed plant and machinery. Instead, it is deferred, awaiting the earlier of the three events that you still, I hope, see on the screen in front of you. At which point, then, the deferred gain will crystallise. Okay. With that in mind, therefore, let's just take you back to the notes. Again, I'd like you to read through. Again, effectively here, what you have is what you've already seen in relation to Chapter 14. You then got a little example to work through and review through the answer to that. Again, the only thing you've got to do there, other than what I've just done with you, you've actually got to compute the indexation factor for yourself. That, by now, should not be a problem. On then to example 2, if you look at the, just to feed you into this, if you look at the nature of these, what have we got? We're told that a building was sold, a building was sold. Again, sorry, the pen does not work, but let me try and again show you. Sold in March 18 for £400,000. In June 18, within the window of opportunity for rollover to be available, bought some land for use in the business for 500. Sold for 400, bought for 500. What does that mean? Full rollover available. Look at example 2. Land sold in March 18, again used in the business for 350,000. Within the relevant time scale, this time 12 months before the disposal, bought a factory for use in the business for 335. Sold for 350, bought for 335. We failed to reinvest all the proceeds. It is therefore partial rollover. On again to, as you can see headed there, depreciating assets. Bought a land for use in the business. Land was sold for 350 in May 2010. In March 2012, bought fixed plant for use within the business. Bought fixed plant for use within the business. Okay, so costing 390,000. Land sold for 350. Fixed plant, depreciating asset. Sold for 350, bought for 390. Full deferral of the gain arising on that sale would be available to you. What then happens? YR Limited sold the plant in February 18. When did they acquire that plant? March 2012, bought fixed plant. This is a disposal within 10 years, thus crystallising the earlier deferred gain. That, therefore, is what you're then going to have to work out. Okay. If you have a go at those, again, further point here, when a replacement asset is a depreciating asset, the gain is deferred as in B above. However, if a non-depreciating asset is purchased before the deferred gain crystallises, the original gain be rolled over against the cost of the new non-depreciating asset. The idea there is you sell a freehold and you buy a leasehold, and that allows a deferral through holdover relief to apply. But before 10 years, before that deferred gain crystallises, let us say you buy another freehold property. What was then originally only held over could then be rolled over. That's the point that is being made here. When the replacement asset is a depreciating asset, the gain is deferred. However, if a non-depreciating asset, a freehold property, is purchased before that deferred gain crystallises, the original gain, that which was only held over, may now be rolled over against the cost of the new non-depreciating asset, the new freehold that now you have acquired. And that will only crystallise, of course, on the sale of that asset. So you might get freehold to leasehold to freehold, where when you went to freehold to leasehold, it was only holdover, but then because you've gone back to a non-depreciating asset, another freehold, before the deferred gain crystallised, then you're able instead to roll over. Okay, work through those examples. Again, then you've got your attempt to practice question 28, and we then look forward to seeing you in our next chapter together, where, having now looked at for the last few chapters corporate tax in relation to capital gains, what we now look at, having dealt with a single company in our introduction to corporation tax, we then deal with groups of companies, where we'll see, and again to do this, you want to revise on what we've just seen about capital gains and also about loss reliefs that we looked at in corporate tax. Also look at the issue of related 51% group companies that we saw again back when dealing with our introduction to corporate tax. All of that then should allow you to better deal with the content of Chapter 22, groups. And we look forward to talking you through that again in the very near future.